Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Paul Curcio, managing editor of ETF.com. And joining me today is ETF.com's crack team of writers and editors. Senior Content Editor Kent Thune, Senior ETF Analyst Sumit Roy, Financial Reporter DJ Shaw, and Contributing Editor Ron Day. We have a lot to cover, so let's dive right in. So this week we ran a series of articles on fixed income, specifically fixed income ETFs. We're ETF.com, so of course we did. Now, each of the writers here took a crack at their own corner of the market for these bond ETFs. So let's talk about each one of these special articles and what each of you have learned from writing about it. Ron, yours ran today, so let's start right there.
Yeah, I looked at the 5 biggest bond ETFs and how they did versus VOO, basically, which is our proxy for the S&P 500. And as we know, it's been a wild year in the markets, and people who wanted to get out of the mayhem and the chaos and the tariffs and the wars and put their money into fixed income probably made a good move. I mean, after 6 months, there's not a big difference between, say, BND, right? The iShares BND or AGG. Nothing is like burning down the house or anything like that. But neither is VOO. The S&P 500, tracked by VOO, has gained about 2.3% so far this year. And then you look at BND, which is the biggest fixed income ETF. Year to date, that's actually beating, just on a price return, that's doing close to 3%. So beating VOO. Then the next largest one is AGG, which is also beating VOO. So far, you can see fixed income is it was a good move if you had done it earlier this year. If you just wanted to park your money. BNDX is underperforming a little bit, and our most popular fixed income ETF, TLT, is actually underperforming a little bit. And maybe Kent's got some insight into that because he is our TLT guru. The one more I looked at was VCIT, which is really handily outperforming VOO. It's got almost a 4% gain so far this year.
Any danger of getting stuck in a yield trap and looking for some of the high returns while seeking some safety and stability in these, yet and seeing the ETF price falter at all during this period?
Well, I am not a financial professional, Paul, as we know, but we do have somebody with these 3 little initials at the end of his name, which is Kent. And I would be very happy to save my reputation and not say something dumb and toss it over to Kent when we talk about yield traps. Kent, please.
Yeah. Well, to second what Ron already said, I mean, there's not a huge gap between performance for a so-called total U.S. stock market index fund like Vanguard's BND or their total international bond index fund. So you can either buy the entire U.S. bond market with BND and the entire, or AGG, also Ron mentioned that, or the entire international or ex-U.S. bond market with BNDX. BNDX is going to get you a little bit more yield and a little bit more price risk, but the differences aren't that broad. Now, as far as yield traps, I mean, when I think of a yield trap anyway, I'm thinking about the risk. I mean, high yield equals higher risk, which means higher price risk. So when you have, say, a recession, a high yield bond ETF is going to perform more like a stock, really, because with a recession coming or a slowing economy, it means that the credit risk is higher or the risk of default is higher. So investors are going to demand higher yields. So on that note, I highlighted several funds, including the Vanguard's International, BNDX.
Oh, and just to be clear, Kent, so that everybody knows, if you're going to start talking about which bond ETFs that you covered for fixed income series, it was international bond fixed income ETFs, correct?
Correct. International, that's correct. So yeah, I was looking at in my the funds that I was highlighting was just a combination of or a range of things, whether someone's looking for the total international bond market, like I mentioned, Vanguard's funds, or if you're looking for high yield. And one of the funds I highlighted there was the iShares International High Yield Bond ETF. You're going to get a higher yield there. It's about 4.5%, which edges out most international bonds, and it's significantly higher than roughly 3.5 or just under 4 for U.S. bond market. But you're gonna get some price risk there. So if things are slowing down, the latest rates I've seen, the inflation has slowed down a little bit. The Bank of England is supposedly easing like less than anticipated, or inflation did. The Bank of England rate decision is coming up. I was thinking about the European Central Bank, and their rates over there are really similar to ours, whether there's a concern about inflation, but it has been slowing, or disinflation has been not it's been slowing a little bit more than expected. In other words, inflation is not a problem there, and so there's not a lot of risk. The economies are slowing, but there's not a high risk of recession. So if you're looking for high yield, that credit risk is not quite as bad as it could be. So we sound kind of wishy-washy because really that's the case. I mean, there's so much uncertainty out there, that it's really hard to nail it down. If you want higher yield, you can get it with international bond funds.
All right. Well, that covers two of our fixed income series articles. Sumit, what was the corner of the fixed income market that you looked at?
So I looked at ultra short-term bond ETFs, not typically the most exciting part of the fixed income market, but it is a growing part, and it's more exciting than it was several years ago because yields are higher now. Of course, you're getting over 4% to invest in treasury bills and things like that. And that's essentially what these ultra short-term bond ETFs invest in. They invest in obviously the most short-term fixed income instruments. So in general, we're talking about things with maturities of 1 year or less, and that includes treasury bills, but it also includes other types of debt like corporate debt, commercial paper, things like that. But as I mentioned in my piece, this is a fast growing part of the ETF market. Traditionally, money market mutual funds dominated. When people wanted yield, they gravitated towards those money market funds. They had stable $1 net asset values, very safe, very easy place to park your cash and just generate some income while you wait. And ETFs weren't really a major player there, but that is starting to change now. Of course, money market mutual funds, they still dominate. They have something like $7 trillion in assets under management. But in my piece, I wrote, now ultra short-term bond ETFs are a player now. They have over $188 billion in assets under management in this category across 41 different ETFs. And it's dominated by two ETFs. It's the iShares 0 to 3 month Treasury Bond ETF, SGov is the ticker there, and the Spider Bloomberg 1 to 3 month T-bill ETF, BIL is the ticker there. They have a combined $90 billion in AUM, which is about half of the total in the ultra short-term bond ETF category. So I think, just like with everything else, people are starting to see ETFs as a viable option when it comes to parking their cash and picking up some yield. So money market funds are still a great option, but if you're an ETF investor, you could put your money into something like SGov or BIL and essentially accomplish the same thing. And you get some of those benefits of the ETF wrapper. You get that intraday liquidity in particular. You can buy and sell these ETFs all day long, while the money market mutual funds, of course, they only trade once per day at the end of the day. So that's the biggest difference. Other than that, risk reward wise, they're both ultra safe. essentially risk-free because they're holding treasury bills. So in that sense, these are no different than money market funds. I also mentioned in my piece, it's not only limited to funds that hold treasury bills. You have some others that take slightly higher risk, like the JP Morgan Ultra Short Income ETF, JPST. That's an actively managed ultra short bond fund. And it gives you a little more yield historically, maybe 0.5% per year more on average. But you are, of course, taking a little bit more risk. You're no longer holding risk-free treasury bills. You're holding corporate debt and things like that, but still very safe because these mature in 1 year or less. Like I said, final thing I should mention is, I've kind of been distinguishing between ultra short-term bond ETFs and money market mutual funds, but that money market feature has now come into the ETF wrapper. It's kind of confusing, but now we do have money market ETFs available. And what the difference between money market ETFs and the traditional ultra short-term bond ETFs is simply this idea that to get the money market label, you have to follow what's known as SEC Rule 2A7. And this is a very strict rule set that, says you can only buy the highest quality type of instruments. You have maturity limits. The instruments you buy cannot mature. They have to mature in 60 days or less. They have to be really short term, right? So these are the kind of like the rules that dictate whether you can call a product a money market fund. But in practice, the ultra short-term bond ETFs, the SGovs of the world, they essentially follow most of these rules anyway. They're holding the highest quality type of fixed income instrument. So in practice, a money market ETF and an ultra short-term bond ETF, pretty much the same thing. You're not going to see much difference. So it is a new category within that ultra short-term bond ETF category, money market ETFs, but I don't think it's going to matter that much. People are still going to be buying SGov, BIL. They're just as good.
No, that's interesting because money markets have been the go-to for people to put their money away for such a long time, and to see ETFs like SGov and BIL and the others that you mentioned come on so strong is really heartening because they're great. I mean, let's face it, you already went down the line. I mean, here you get great yield, you get liquidity that goes with it. You could trade them anytime. You get low expenses, low fees on it,
Yeah.
and you get all the security of the faith and credit, good faith and credit of the United States government on many of them, especially like SGov. Yeah, it's an amazing opportunity. All right, one more. DJ Shaw, what did you write about, sir?
I got to cover active fixed income. The category was pretty interesting. I'll admit I don't cover fixed income as much as everybody else, but I learned a lot through reporting on this story. It active bond ETFs became a major theme in the fixed income space this year. As I was reporting this story, I found that active fixed income ETFs pulled in nearly half of all bond ETF flows so far this year, which is a big shift, as it kind of speaks to the investors are behaving, and how they're changing in response to just so much market volatility, and kind of adapting to the sense that you can't really trust traditional forecasting anymore. So I spoke with the fixed income teams at BlackRock and Invesco, and kind of a common thread that emerged between both of them was how uncertain things feel right now. Jason Bloom at Invesco told me that he's never seen a multi-year stretch where the Fed and market forecasters were this consistently wrong on things like growth, inflation, and interest rates. And that's left a lot of investors and financial advisors looking for more professional guidance. And that's kind of why they've turned to active ETFs. It gives them, the ability to offer the benefits of fixed income with within the ETF wrapper, so they still get tax efficiency and transparency, and the ability to trade intraday. What stood out in this story was that the growth in active ETFs isn't necessarily coming from at the expense of passive ones. The team at BlackRock explained that active strategies are actually pulling in new flows. So investors who may have been on the sidelines or who want more flexible tools to navigate the risks are coming in, and it's not taking away from what's already been kind of popular or being used more. The firms I spoke with, BlackRock and Invesco, they both were pretty early movers in the active bond ETF space. Invesco has funds like GSY and GTO that were on the market for almost a decade, and BlackRock launched BINC, which has already grown to $9 billion in assets over the last 2 years. I think it was launched 2 years ago. But yeah, in a nutshell, what I found was that active ETFs are quickly becoming a go-to tool, not just because of performance potential, but because of how they can fit into a portfolio when there's a lot of volatility in the market.
Well, it's definitely a topic that we've been following and continue to follow. We have a story this week on the rise of active over passive ETFs, which everybody should check out. It's on our site now. Thanks, DJ, for talking about your article, and everybody here had a great series of articles that are really informative and will be a great benefit to our listeners and our readers. Earlier this week, I had the opportunity to talk to a special guest about fixed income ETFs, so let's listen. Joining us now on the Exchange Traded Fridays podcast is Matt Brill, Senior Portfolio Manager and Head of North American Investment Grade Credit at Invesco. Welcome to XTF, Matt.
Hey, Paul, thanks for having me.
Pleasure to have you here. So there's been significant growth in active fixed income ETFs over the past few years. What are some of the active ETFs you manage, and what sets them apart in today's market?
Yeah, so we've seen huge growth within ETFs, specifically for fixed income, active fixed income over the last decade, but it's really kind of accelerated the last 5 years. So just the last 5 years, you've seen a growth rate around 17% annualized for active fixed income versus active mutual funds for fixed income are only around 3%. So about, call it 5 times the growth rate and more than double over the last 10 years, but it's really started to accelerate. We've had GTO, which is an active core plus type mandate that we've had for nearly a decade now. We're going to hit our 10-year track record coming up pretty soon. And we also added GTOS, which is a shorter duration version of that. And soon we're launching GTOC, which is going to be core. So we're going to have 3 different varieties for active fixed income, kind of choose your own adventure, if you will. But we think the ETF space is the way of the future and where the growth is going to be. So that's why we're really kind of focused on that from a product development standpoint.
So how are investors using active fixed income ETFs in portfolio construction today? Are these funds replacing mutual funds or bond ladders, or are they being used more tactically?
So you're seeing a little bit of everything, but I'd say the biggest trend we're seeing is that people are either adding new positions within ETFs or actually selling their mutual funds to roll into ETFs. So that's been the main trend we've been seeing. We do have ladders here in Invesco. We have our bullet shares. We do have some clients that will use a particular maturity date that they want to own, which they can get exposure to through the bullet shares. But what my team is really focused on is taking advantage of active fixed income. We think that the general kind of off-the-shelf product you can get, the passive ETF or the passive mutual fund for fixed income, is a little bit outdated. It's very high quality. It's got 45% in treasuries. It's got 35%, or excuse me, 25% in agency mortgages. So it's got about 70% in just AAA securities. And we think there's other options, high quality corporate credit, a little bit of mix of high yield, potentially high quality structured credit in there as well. So there's other areas that we can get you additional yield while still staying up in quality. So you kind of get the look and the feel of a passive fund, but you're going to get better yield and better total returns over time, we think, if we do our job well.
And what are the key advantages active managers bring to fixed income ETFs compared to traditional passive index tracking strategies?
Yeah, so I think the difference between mutual funds, or excuse me, passive versus active within fixed income versus equities, and I don't like to speak poorly of equities. It just seems like the percentages are lower for the ability to beat the benchmark in the equity world. It's harder, perhaps. I'd say if you look at the fixed income world, the success ratio of active managers beating the benchmark for a core plus strategy is significantly higher than 50%. And for core strategy, this doesn't include any high yield or any EM, is going to be at least 50%. So historically, active fixed income managers have been able to beat the benchmark. You kind of get what you pay for. So that's been good. A few reasons, I mentioned the high quality nature of the AAA portion of the passive benchmarks, but also if you just think about the way that benchmark would be constructed, a a fixed income fund is going to give the biggest amount of exposure to the person or the companies that have the most debt. And so if you have the most debt, you by definition are going to be the largest of the index. And we don't necessarily think that that's a good way to lend to people. I wouldn't want to lend to you just because you already have a lot of debt. Why should I give you more debt or more access to capital just because you have a lot of debt? That doesn't really make sense. So what we want to find is companies that have a little bit of debt and are actually looking to reduce that, have some sort of catalyst towards balance sheet reconstruction, balance sheet improvement, which with that, their credit spreads or their risk should go down, and we should make money off of that. So we don't want to just lend to whoever has the most debt. We want to find active management through our fixed income analysts. They're kind of identifying great opportunities for improving credits.
So I would say it sounds like junk bond ETFs are not on the menu.
Yeah, for us, I mean, we will own some high yield in our funds, but what we want to do is really customize it or give that up in quality approach. So we don't want to just buy whatever's out there. If it's just happens to have a lot of debt, no thanks. But if it's a double B company that maybe is in a tough space, but all of a sudden is starting to really hit its stride, is delevering, has a path back to investment grade, we think those are great options. So that's where we think we can add a lot of value and really, just a lot of alpha to the portfolio over time.
Interesting. So we keep hearing about growing government debt and record levels of treasury issuance. Should investors be concerned about the long-term impact on the bond market stability and performance?
Yeah, so we've obviously going through, this budget balancing, the big beautiful bill, and there's questions, where's the fiscal discipline of the U.S. government? Is it there or is it not there? And we definitely see, the overall deficits have been increasing with time and really accelerated, last decade or so. And with that, the U.S. does have a lot more debt than it used to. And so we do think with time, this will be in focus, and there will be politicians will eventually address this. But it may not be tomorrow, but eventually, we do feel like the government is still money good. We still feel like the U.S. is the reserve currency, the U.S. dollar is reserve currency. So we're not concerned in that regard, but there is a lot of supply if they have to issue a lot of debt, which can weigh a little bit on overall yields. But where we are now, and we're seeing a large technical where there is a lot of buyers that want to come in at 5% on the long bond or 5% on the 10-year treasury. So there is a lot of buyers we think that will step in. But the flip side of that is actually, if you look at the issuance of corporate debt, it's materially less. So corporations are in a lot better shape than the government is. So like I said earlier, we don't have to just invest in the government because they're 70% of the index. We want to invest in other areas that we think have better credit quality. And I want to say Microsoft is better balance sheet than the U.S. government, but it might. And we have that ability to get more spread while we buy Microsoft rather than just simply U.S. treasuries.
Interesting take on this. So at the time that we're recording this, we're still waiting for the Fed decision, the notes from the Fed meeting. So I wouldn't ask you to try and prognosticate what things look like for the rest of the year in terms of that. Putting that outside of your outlook, what do you see going into the second half outside of any Fed moves that's shaping the markets over the second half of the year?
Yeah, so the first half of the year was all about tariffs and the impact of the economy, and that will probably play through in the second half, right? So we'll see how it affects the economy. But overall, we would say where the Federal Reserve is at 4.25% to 4.5% overnight rates, that is restrictive. We think that is trying to slow the economy. And at this point, we're not necessarily sure that is warranted. We think the Fed can actually start to cut because we think inflation is going to come down. Now, some people think that tariffs are inflation, but in our view, tariffs are a pass-through. They're basically a tax. And with the tax, you're going to get less consumption, not more. So we think it's different than inflation. And so we think the Fed is actually poised to cut, and they should cut next. Probably as early as September, we'll see. But certainly before the end of the year, we'd expect at least to get one Fed cut. Now, that being said, we think the Fed can cut because they can, or the Fed will cut because they can, not because they have to. And what I mean by that is if the Fed has to cut, it means the economy's kind of fallen off the rails. They're behind the curve and they're cutting like crazy to try to stimulate the economy. The reality is we just think the economy is starting to slow a little bit, and inflation has been fairly muted. And we think that, again, the tariffs are kind of a pass through and not actually really inflationary. So the Fed can cut and will cut, we think, later in the year, kind of as a preemptive, just easing rather than a retroactive, we're behind the curve, we need to cut as fast as possible.
Interesting outlook. Yeah, I tend to agree with you that at some point later in this year, the Fed will cut. But as of this week, and we don't know yet what they're going to decide to do, I don't think anybody's expecting them to cut here in June. So we'll see what happens. We'll see if your prognostications reign true. Well, Matt, this has been an enlightening conversation, and I want to thank you again for joining us on XTF, and I wish you a great summer. Thank you. Thanks to all our listeners for streaming or downloading Exchange Traded Fridays. Remember, if you haven't already, please like or subscribe or follow us wherever you get your podcasts. If you have a question or just want to share your thoughts, join the conversation with us on X, formerly known as Twitter, where our handle is @ETFCOM. See you next Friday.